lot of people will talk about us not paying claims, but I'm here to tell you that that's not really the case. So just a quick housekeeping topic. You're here for 1 hour of credit, which means I have to speak for 50 minutes. I know how important everyone's time is, so I have my timer right next to me. When I get to 50 minutes, I'm going to stop. If I do finish early, I will answer whatever questions have been put in the chat. If I don't get to your questions, don't worry. I will take all of them, and I will, if you send me your email address or in the chat, or Diana has it, I will answer all the questions over the next day or so. So with that, let us get started. So it's time to discuss claims. And an important thing that I want everyone to remember during this presentation is that claims are really a way for us to show our customers the value of our title products. And that title insurance, it really is there to mitigate many risks that are inherent to the selling, the buying, and the encumbering of real estate. You know, even though we at First American and at Judicial are getting better at what we do, the same can really be said for the fraudsters and thieves out there that are looking for ways to get equity, encumber properties. And we're going to go through a few of those scenarios. And reviewing these claims that we've seen is a great way for us to learn about some of the nuances of our industry that have led to mistakes for others, resulting in losses, and how we can really avoid those going forward. So let's get started. Quickly, we're going to just, in our agenda, we're going to start with typical claims we see in terms of different categories, why they may be happening. From there, we're going to go into the causes of some of these claims. And then we're going to get to the part that everybody loves from this presentation, and that's the actual claims, the meat and potatoes, the horror stories, and the lessons we really should be learning from them. And at the very end, how claims should be handled, who you should be contacting, what do you do if you have a potential claim. So where are we seeing the claims? And this is from 2022 because the 2023 data is still being processed. The largest area comes from no error. Now you might be asking, what does that mean? No error, a lot of people are shocked to learn that this is the biggest driver in claims, and it occurs in the area of the title process where stuff is just covered by title insurance, back chain title risks, competency issues, some types of fraud, expanded coverage policy matters. And these are just items that are sometimes unpreventable, or risks we just assume. No matter how well we underwrite the file, they might just be something that you can't account for in the situation. The next biggest area is the closing process, and I'm just giving overall terms for these. We're going to go through a lot of the underlying categories in detail. So closing prep process, we're going to talk about. From there, the search and exam is at 19%. The 6% is underwriting. So this is when we are making business decisions potentially, or we're just making a decision on whether we think it's an acceptable risk. 3% is denied claims. So you see it's very little. 0%, you see two categories there. That is for defalcation or other. It's less than a percentage point for those. So let's talk about the causes of claims. Doing something the way we always did is not necessarily indicative of the best way to do something, or even continued success. You know, we hear a lot, well, that's just the way we've always done it. Well, the Spanish tradition says that the true origin of the bull run began in northeastern Spain during the early 14th century, when transporting cattle in order to sell them at the market, men would try to speed the process by hurrying the cattle using fear and excitement. After years of practice, the transportation became a competition as we know it today, where young adults would attempt to race in front of the bulls and make it safely to the pens without being overtaken. When the popularity of this practice increased and was noticed more and more by the expanding population of Spanish cities, a tradition was created and stands to this day, which is the running of the bulls. I'm just trying to illustrate here that maybe this isn't the smartest way of doing things. It might be the way that's always been done, but it doesn't mean that there isn't a better way to do it going forward. And we use claims as a way to teach us what are potential better ways to do something going forward. Sure, this might be a way we treat surveys in the last 10 years, but we see this process has led to some claims. So maybe we need to take a different approach going forward to really cut those off at the knee. All right, so biggest sources of claims that we see: prior mortgages. And this is going to be split up into three separate categories. There are the prior owner mortgages, which is prior chain, right? It's not the current seller, but maybe the seller before, or going back multiple sellers. Just because we're being told that it has been paid off doesn't actually mean it was. So what are we looking for here? We're looking for a foreclosure search that might reveal a prior open mortgage. Did we check to make sure SATs were properly recorded, received, acknowledged, notarized? Are they given by the right party? Do we have the right documentation and authority on those mortgages? Are they coming from the correct lender? Are they so old that maybe an ancient mortgage affidavit was given, taken? There are always ways around it, but we want to make sure that we're actually getting the correct information, specifically when someone is telling us it's been paid off. Current owner mortgages might seem like an easier type of mortgage, right? Because hey, the person's still entitled. They can contact their lender, but we shouldn't be fooled, and we should really treat these with the same vigilance that we would treat a prior owner mortgage, when making sure that they've been appropriately satisfied or consolidated. Was it done in connection with a refinance? Was it done in connection with the sale? Was it potentially just a mortgage was paid off, not in connection with a refinance or a sale in the last 2 years? Do we have proof of payment? What we're checking there is to make sure that someone didn't put a fraudulent SAT on, and now we go to close, we see, we have this fraudulent SAT, and we can close without taking into account the lender's interest, and then the new buyer comes in and gets a foreclosure notice going forward. And then there's credit line mortgages. When we're looking at these, we're looking for letters stating that the credit line has been frozen. Really, a payoff letter stating the credit line has been frozen is the best. And additionally, an affidavit from mortgagor or date of letter to date of closing saying everything's been frozen, no further draws, nothing's been taken out since. Moving on from there, we have claims within Schedule B exceptions. So insured owner submits a claim as a former owner filed suit to set aside a foreclosure action. It was originally denied under an exception of Schedule B, which was former owners in possession. Well, it turns out the language in the policy was transposed, and the former owners were not in possession, but actually tenants. So it doesn't really fall within a Schedule B exception, that Schedule B anymore. Outstanding interest. This is a case where you are insuring a deed from purportedly all of the heirs. Well, how did you determine that all of the heirs had been consented or served or were included in the process? Are you getting heirship affidavits? Has it been a certain amount of time? Are they listed in the probate? How are you making sure that there are not more parties coming out of the woods claiming an interest? Defective documents in the chain. This is signatures, acknowledgments, mortgages. We're going to talk a lot about this one in some of the cases and in a couple slides. Recorded CNRs, omitting them when it's inappropriate to omit them, making the determination that they have either expired or that they are no longer in effect, when really that's not the case. A good example is insured is in a final stages of a site plan approval process for, let's say, a 45-unit multifamily development. And they are told that there are restrictive covenants that preclude them from building this. Someone maybe omitted them because it was their, one we hear often is a change in the character of the neighborhood, no longer making the restrictive covenant necessary. Maybe interpreting a cutoff date or an expiration date when really there was a renewal or it runs with the land and there really wasn't an expiration date. Those are all different ways we see CNRs being omitted when they really shouldn't have been. Unrecorded or lost docs. This is a big issue also that we're going to be talking throughout the presentation. Not recording the docs timely or at all is one of the bigger issues that we sometimes see in the business in certain counties specifically, and has led to a couple of our largest claims in the state of New York. And then escrow shortage matters. This is not taking enough on a mechanics lien escrow, judgment, federal tax lien, water search, ECPs, anything where we don't take enough money to cover penalties and interest potentially. So let's start with the closing process. The escrow portion of the closing has become really a hotspot for claims and losses, specifically in recent years. Losses to a title insurance company were or used to be mostly related to the search and exam of the land evidence records and any of the normal covered risks in the policy. Well, the modern closing has shifted to the escrow portion of the closing. And this includes everything from the receipt of closing instructions to recording. And this area has really become a minefield for even the most careful of closing professionals. So the concept of the escrow closing, it really encompasses almost everything in the closing of an insured transaction, other than the search and exam. And as we're going to go through the closing process, there's going to be places and pitfalls where we can see. And let's start with closing instruction letters, also known as CPLs. We get asked these questions a lot, usually by out-of-state lenders. Closing instruction letters cannot be used in New York. They are a violation of the regulations in New York. And sometimes you may be asked to issue these CPLs where the instructions may be kind of written out in a way to expose loopholes, but they should not be issued and you should be staying vigilant for them. Payoff issues, everything from the ordering of the payoff at a proper date to getting the correct amount on the payoff to the correct party at the correct time. So, we want to make sure that everything is as up to date as possible when going into the closing. Obtaining the correct documents and preparing and reviewing those documents. This closing obligation involves all documents, deeds, affidavits, subordinations, and the actual insured closing documents themselves. This is where your closers are extremely important, specifically at the closing. They are you and yours last lines of defense. This step, it takes place at multiple levels, but if we get to the closing, we're really counting on closers to catch any last second issues in the documents. And then the identification of suspicious documents and persons. This is really part of the escrow process because to some large extent, the person with the last opportunity to stop a fraud from happening, after it's gotten past a few people, is the person at the actual closing table. And that's the folks and staff back at the offices. We like to recommend an ID book check for closers. These ID books cover every state's versions of driver's licenses, what to look for, what might indicate a fraudulent driver's license. And finally, the recording of the closing documents, getting them recorded timely and in the right order, and getting them recorded in the right place. Recording in the gap timely. We're looking to avoid fraud by borrower or other parties. We're looking at federal issues like the safe harbor 30-day rule to prevent the unwinding. One of New York's biggest claims and payouts was regarding this type of issue, and it cost about $13 million to settle the claim, as the mortgage was not recorded in the 30-day time period, and a bankruptcy trustee came in and unwound the whole mortgage. If that mortgage was recorded in that 30-day period, no loss would have occurred there. And you may be asking, well, how often does it happen? Clerks reject mortgages all the time. We're going to see in a couple claims that it just happened because rejections occurred, delays occurred. We're looking to avoid unnecessary delays. I understand that there are going to be delays sometimes. There are going to be unavoidable delays that occur. We're looking to stop the unnecessary delays. All right, so let's switch to the document prepare and review. And people are often surprised to learn that this stage is one of our highest areas of claims. Would it surprise you to learn that in some states, not necessarily New York, but in some states, about 30% of all claims dollars paid arise from the failure to have a proper legal description on both the insured mortgage and or the failure to have both the husband and wife sign the insured mortgage when both are entitled. So you may be asking, how does this happen? So for the husband and wife issue, both spouses own the property, but only one may have good credit. So the lender sets up the deal where only one party is the borrower, and sends you the loan documents, including the mortgage, with only one party signing. So we as closers have to be vigilant about reviewing the loan documents and issuing policies with the title commitment nearby reflecting the state of title, and making sure that there is identity between the title and the mortgage. And we're going to talk about a specific case of this later on. Sometimes those errors are quickly and easily fixed with reformation actions, but sometimes bankruptcy courts can get involved. We can deal with divorces or unhappy parties, uncooperative parties, and that's where the losses can start to snowball. More and more, the formalities of witnessing, notarization, signing are becoming the subject matter of claims. We've had claims all over the country with the following fact patterns. The insured mortgage was signed, the signatures were witnessed, they were notarized, and there was a proper legal description, and the document was recorded. But when you took out your microscope and you looked at the very notary clause that was there to show the document was properly acknowledged, you'd see that the state and county were filled in, and the date was filled in, and the name of notary was both signed and printed, and as was their expiration of their notarial appointment. However, the recitation in the notary block said, "Before me appeared the above named borrowers, blank," and nothing was filled in. That is a defective acknowledgement for all intent and purposes. One of the newest activities over the last few years are webcam notaries. I'm sure everyone's heard of Ron and Rin, where companies are trying to take the market by storm. It's important to remember there are some states where notary laws do not actually follow these types of notarizations or may have different processes than New York does. It is important to be vigilant and remember to contact judicial if need, First American, and if you need help with these kind of situations, because we don't want the unwinding of a mortgage or the cancellation of a deed due to following the incorrect procedures or incorrect processes when it comes to a remote online notarization, for example. Quickly going through recording, we kind of talked a lot about these already. The failure to send documents in to record, the failure to timely send documents to record. We've got one claim we're going to talk about later that specifically mentions these two. Documents rejected by the recorder and not resubmitted. Documents recorded in the wrong location. Documents recorded out of order. This one happens more than you think. You want a mortgage in second position, it ends up somehow in sixth position now. If we have 6 mortgages being submitted all at once. Well, how do you fix that? You might need to go and get subordinations now for the other mortgages that are above it. And that's assuming they're all coming from the same lender. Mortgage fraud has become very prevalent or more prevalent over time and is a particular concern during times of economic recession like ones we're dealing with right now. And the reason for that is there are factors that contribute to both an uptick in mortgage fraud, which is an upheaval in the housing market, boom or bust, and homeowners are facing foreclosure and looking for assistance in any way they can. And unfortunately, there are people out there who are looking to use that scenario to make easy money, take advantage of people in need, and they contribute to a climate where mortgage fraud runs rampant. And I want to be clear, this is a broad term that can refer to many different activities. It's inflating of an appraisal, claiming income or assets that you don't actually have, posing as a borrower, or pretending to help in order to take equity. So some things we're also looking for are flip indicators. Some of the following are red flags that occur in flips that not necessarily should make you say, oh, this transaction is fraudulent, but should just keep you on your toes a little more. Ownership changes, which there are 2 or 3 more in a brief period of time. 2 or more closings occurring almost simultaneously. I'm going A to B and then B is going to C at the same time. The property has been owned for a short time by the seller. Again, I want to be clear, these are not immediately, hey, this is fraud, but this is something you should keep an eye on, potentially. This property seller is not even in title yet, and they're already trying to sell. Parties to the transaction are affiliated. Up and down fluctuation of sales price over a short period of time. You sell it for $150,000 in January, and then in July, you're selling for $500,000. Well, what happened? Was did somebody build, which would provide evidence that increase in price is justified, or is someone now trying to just inflate the equity here? There's the builder bailout scheme. So builder inflates value to $240,000. They find a buyer, a lender funds a loan for $200,000, thinking there's $40,000 in equity to be paid to the builder. Well, in fact, there wasn't, and the builder forgives the buyer's down payment and keeps the profits. There's no equity here if that goes to foreclosure. Some other type of schemes, or the most common schemes that the FBI has kept a running list on, foreclosure rescue schemes. So this is why we had the Home Equity Prevention Theft Act. There's the phantom help, bailout, bait and switch. We're going to talk about the phantom help. We just talked about the builder bailout. There are loan modification schemes, illegal property flipping. Again, I want to emphasize illegal property flipping. Property flipping is not illegal on its basis. Plenty of people do it. It's the type of property flipping where people are taking advantage of others. That's what we're looking to stop. The builder bailout, condo conversion, also known as equity skimming, and the silent second. These are all just common schemes the FBI is keeping track of that are really the headliners, I guess, for what's going on. Here's the Home Equity Theft Prevention Act. It's also included in your materials. If you don't have it, you type it into Google. You can find it very easily as well. Okay, so for everyone, here is the code for today's presentation, 1125. It's important you write this code down so you get credit for listening to me speak for an hour. So again, 1125. I'll give everyone a couple seconds just so they look up and write it down. Okay, so with that, let's move on to our first story, our first claim. This one we like to call the betrayal of trust. And in this story, we have all the elements of a great story, a potential helpful story, with a happy conclusion. But we also have the makings of a disaster at the hands of a professional fraudster. So let's see if you can spot who is the professional fraudster, the red flags, and who our victim is before the end of the story. So let me introduce you to Chuck on the left. He's a small entrepreneur with some minor holdings that provide a small sustainable income. He's purchased the property in the hopes of making some minor improvements and a financial windfall at the end. Sounds good? This is a common practice that we all know about, and it can be lucrative if it's done right. Unfortunately for Chuck, he didn't do it right, and he found himself having difficulty making ends meet after a string of bad luck. Now let's meet Wilbur on the right. Wilbur is an experienced investor, always looking to make a good profit. He's financially sound and has made a steady living with his investments over the last decade, allowing him to live a somewhat lavish lifestyle in addition to lining his own pockets. Wilbur also likes to help others, and he is the proud provider of foreclosure rescue to those behind in their payments and in need of help. So what he does in exchange for a portion of the proceeds when the property is sold or refied, he will take title as a trustee and make the monthly payments on the existing mortgage. He has successfully executed this plan many times, and it's always served him well and the owners of the houses in the past. Well, seeking help, Chuck found Wilbur's online advertisement and immediately called to get the ball rolling. The two met, hit it off right away, and Wilbur listened to Chuck's story and promised that he would help him. In the following days, Chuck deeded the property to Wilbur as trustee of a newly created property trust. And then Wilbur then brought the mortgage current and began making the monthly payment, giving Chuck some much needed financial relief. All seemed to be going well for both of them. Well, this is where things become interesting. See, now that the mortgage had been brought current, Chuck decided he didn't need Wilbur anymore. So he created and recorded a termination of trustee document. Next, he applied for a brand new $250,000 mortgage on the property. And we need to understand that the termination of the trustee is not effective in removing the existing trustee without a resignation or a court order. But it worked for Chuck because we accepted the fraudulent termination document and hey, we insured the new lender. Not knowing that he'd been double-crossed, the Wilbur trustee attempted to sell the property. Naturally, through a title search, Chuck's plan was revealed, showing the newly recorded documents, and Wilbur was infuriated. He sued, and believe me, he won. To resolve the claim, we ended up paying a claim on the insured mortgage, as well as money to Wilbur to reimburse his investment. In addition to all this, there were attorney fees and court costs, bringing the total loss close to about $300,000. What makes it worse is we later found out that Chuck had a history of real estate fraud. We all say that hindsight is 2020, but a simple Google search here may have helped us to avoid this one from the beginning. So, what are the morals of the story here? The moral of the story is we should always take care to confirm that the party executing the documents we're using to establish title really has true legal authority to do so. Authority is a major issue for us at this point. I get it. Some people don't want to hand over LLC documents, trust documents. They think it's personal, or they think it might have information that they don't want getting out there. But we as a title company need to be able to establish authority to prevent stories like this from happening. This is particularly true when presented with the matter of trust. We need to make sure the trust is still in effect. Here, we need to make sure the trustee is still in effect. There hasn't been a successor trustee or a new trustee appointed. What can we do to prevent this type of fraud on future transactions? Following through and ensuring that the acting trustee is legally designated. And if we're dealing with a successor trustee, making sure the resignation of the previous trustee has been properly documented. Proper due diligence will assist in resolving these matters before they really happen. So when I'm in person, I like to ask, were there any red flags that should have caused further investigation? And a lot of ones that get hit all the time, or the silent second, or someone coming in and bringing the mortgage to date. A lot of people start this story thinking that Wilbur is going to be the fraudster, that he's going to do something, when in fact it's Chuck in the end. So let's switch gears to cybercrime quickly. More specifically, wire fraud. So what is it and what does it have to do with me? I do a cybersecurity presentation also that this is a very common topic. Theft of personal information or passwords or confidential info can lead to an economic loss for you, your client, your company. You don't want your company to become the next victim of cybercrime, specifically in the wire funding world. Wire fraud, it really is sometimes becoming an epidemic. Most fundings at this point are done over email, and hackers are really taking advantage of this. How are they doing it? Well, they're changing wire instructions. They're doctoring emails. They're hacking and intercepting wire instructions and emails. And they're becoming more and more dangerous. So how do we combat this? Well, again, staying vigilant is the number one way to combat this. If someone's trying to change wire instructions on a Friday or a holiday, that should be an automatic red flag that maybe something is off there. Wire instructions should be sent out at the beginning of the beginning of a transaction, and I'll tell you, 99% of the time they don't change. So if someone's telling you they're being changed, make sure it's from a trusted party. Pick up the phone and call someone there, because emails are too easily intercepted at this point. So can you tell the difference between these two email addresses? Probably not. I'll tell you, one is a lowercase L and one is a capitalized I. So if you were to receive these two email addresses and one of them was telling you they need to change the wire instructions, how would you combat the situation? Well, one thing I can tell you to do is maybe copy and paste to a Word document, change the font, and you can see the difference between a lowercase I and a lowercase L and an uppercase I. Another thing we recommend is, instead of replying all, you forward and type in an email address that you trust and know. So if you work with me all the time and you see my email address is avozza, it's avozza capital L or avozza lowercase L or avozza capital I, whichever one it is, and I'm sending you an email telling you I need to change wire instructions. Well, maybe instead of replying all, hit forward, type in my email address, and I'm sure mine will populate, and just respond to that. And then you'll probably get an email saying, hey, what are you talking about? I didn't change the wire instructions. That's definitely one way to avoid this going forward. So let's just talk about some cases on cybercrime. This one's good in quotation marks, I will say. This is from March 2010. It's from the Village View Escrow v. the Professional Business Bank. Here they caught the virus when the owner received an email from UPS saying there was a problem with a package they had sent. Well, 26 consecutive wires were then sent out over 2 days, all over the country, and totaling $465,000. Here, there was a happy ending because the bank had established an email notification process. And this is where I say it's in quotation marks because 2 days is still too long for me. Speed is key when it comes to wire fraud and cybercrime. The quicker you realize you have an issue, the quicker you can handle it and you can prevent large losses. But it is a good case compared to these two. So December 2012, January 2013, Efficient Escrows Group in California. Well, they were hacked for 1.5 million, which was wired to China and Russia. They did recover about a third of it, but there was 1.1 million lost. They were shut down by the state of California in July of 2013. 2009, Choice Escrow v. Bank South. Here, the hackers obtained the escrow company's online banking ID and password and made one transfer for $440,000. Well, Choice sued Bank South, alleging that its online commercial banking security did not meet the requirements of the Federal Financial Institutions Examination Council, which is the single factor, one password, one person. Please use dual authentication in all walks of life if possible. That is a big message from me, specifically in my cybersecurity presentation. Well, here, Bank South alleged that Choice was specifically offered but declined in writing the use of these dual controls and dual authorization, and that Choice had specifically declined to limit the number of wire transactions in a day. That part doesn't really matter here because there was only one, but it's the rejection of the dual controls. District court judge found in favor of Bank South because Choice had specifically rejected the use of these dual controls. And then it was upheld a year later in the Eighth Circuit. And if this was you or your client, that's a large sum of money out of pocket. And someone is always looking for someone to blame in those cases, whether it's the title company, the agent, the attorney, the client, the bank. You don't want to be put in that position. Another quick case, out of possession and adverse possession. You know, we hear a lot of times, well, it's only 6 inches, it's only 7 inches. Why do I have to raise out of possession? So I like to raise Meckler v. Schnell, which is where a neighbor brought an adverse possession seeking title to a strip of land only 3.7 inches wide. So what is important from a title insurer's point of view is not the ultimate holding of the case, but the fact that the neighbor would actually bring the action over this 3 3/4 inch wide. Because regardless of whether we win or we're successful in defending the action, it's the fact that now we have to go and defend, and it sometimes will lead to a more conservative approach in underwriting survey variations and out of possession. And this is specifically important in the 5 boroughs where a couple inches can be the difference between having enough FAR to build, having enough land to put up maybe another story, whatever the case may be. So it's just important to realize when we're talking about survey variations. All right, so let's talk about some more stories from the ugly side, from the other side, as I like to say. So this one we call a life tenancy. And the property in question here is a residential duplex in Staten Island, New York. So our agent here was asked to handle the property in question from a mother, Mary Olson, to her son, Jeffrey Olson. The closing was considered routine, and the new owner's policy was issued to Jeffrey in the amount of $210,000. As well as a new loan policy issued to Citibank in the amount of $173,000. Well, not long after closing, Jeffrey left home and his mortgage became delinquent. So you see, in this property, he had a wife and 4 children in the upstairs unit, and his mother was in the downstairs unit. The insured lender commenced their foreclosure, thinking there would be no issues, and it was probably around this time that they first noticed that the deed from Mary to Jeffrey also created a life tenancy affecting the property in question for his mother, Mary. Well, the insured lender completed the foreclosure and then they sought to evict Mary. But the court ruled against the lender and in favor of Mary, saying that her life tenancy was superior to and unaffected by the mortgage interest of the lender. First American ended up having to purchase our insured lender's interest. And in this case, what really didn't help the situation is the life estate was created in the very deed that formed the basis of the transaction we insured. Yet it passed at closing. No one apparently noticed or really understood the significance of the language of life tenancy included in the deed to Mary, which was very prominent in the deed. It was probably listed in 3 or 4 places. And the insured lender also was represented at closing by an attorney, and their attorney missed it as well. So since Jeffrey's ownership was subject to Mary's life estate, the mortgage given by Jeffrey was likewise subject to the life estate. And in its lawsuit against Mary, the lender tried to advance the position that it should enjoy priority on a theory of equitable subrogation. But the court wasn't impressed. And this leads to a question, what if Mary had executed the insured mortgage as well? What if she signed off on it? Well, in that case, the lender then could have foreclosed upon her interest as well. And this kind of goes back to that notion we were talking about, the identity of mortgage versus the identity of title, making sure you have the right people signing at the right time. It's also important to note that a lot of investors in the secondary market will not knowingly purchase a mortgage which in any way involves a life estate for these reasons. It's really important that we describe the life estate in Schedule A of our policy. Otherwise, there could be a similar problem going forward. Not so much having to do with the policy coverage as having to do with an alleged misrepresentation by the policy format. The thing Rich talked about, how I've been in the business for so long. I started off as an intern. The number one rule that was instilled in me as an intern from top down was know your deal. If you don't know your deal, why should somebody else? So in this case, knowing there was a life estate should have been one of the most important things that was being addressed in the closing process. So from there, let's keep on that same track. Parties on title equal parties on mortgage. And this is another story about making sure we have the right parties signing the right documents. So we have Kevin and we have Mary Ann, and they're married, and this is a wonderful time for them, and they own a house free and clear of any liens. Fantastic. Well, unfortunately, Mary Ann and Kevin get divorced in 2005. Kevin gets full title to the house, and Mary Ann gets a mortgage on the house. And dates are very important here, so bear with me. Representing her settlement at the time of the divorce. So the mortgage was for $105,000, and the mortgage was dated July 15th, 2005. Well, Kevin quickly got himself a new girlfriend named Carrie, and on August 25th, 2005, deeded the house in his name to himself and Carrie. And then he recorded that deed in September. Mary Ann around this time decided, I need to get my mortgage in the land records, and that goes on record in November of 2005. So we're already potentially seeing some issues here. Later on in May of 2006, she goes and sells and assigns her mortgage to an entity which is one in the business of buying these types of mortgages and deeds of trust, and one who thought it was a good idea to get title insurance on the mortgage it purchased. First American's agent, who was contacted to issue a policy, located the deed into Kevin and Carrie when they did their title search, and subsequently issued the policy as of the date of mortgage was recorded. And then they also took a valid exception for the deed into Kevin and Carrie. Well, flash forward about 4 years to 2010, and our new insured under this policy, the holder of the Mary Ann mortgage, wants to foreclose and says, well, wait a minute, I only have a half interest mortgage. First American responds and says, that's fine, but our policy takes exception for the interest of Carrie. We don't think this is a big issue right now. Your mortgage is worth $105,000, and the property is worth $250,000 to $300,000 at this point. Even with a half interest, you're not going to suffer a loss here. So there was an agreement between the parties. Everyone moved on from there, and then they did their pre-foreclosure work and came back to us saying, "Well, what about this other mortgage?" What do you mean other mortgage? Well, it looks like when Kevin deeded to himself and Carrie in September of 2005, he took out a big mortgage himself of $340,000. You might be asking, well, how was this missed? And when he issued the policy to our insured, how did this not come up in the title rundown? Why? Well, because the attorney who closed the big loan didn't get both people on the face of the mortgage. Kevin had bad credit. Only Carrie was qualified to be the borrower. The mortgage was prepared with only Carrie's name, and this happens all the time, right? Interestingly, the closing attorney did pick up on this issue, and Kevin actually did sign the big mortgage, and his signature was duly notarized, but no one put him on the face of the mortgage. No covenants granted. It wasn't indexed under Kevin, and never got found out when First American's agent ran down Kevin's name. Of course, the searcher did find the deed from Kevin into Kevin and Carrie. So why he didn't run Carrie also, well, that's a different problem for a different day. So back to our story, we tell our insured, the holder of the Marianne mortgage, who all we have to protect, right? Well, look, you have no problems. Two wrongs kind of make a right here. You have the first and only mortgage on Kevin's half interest of the property. Foreclose on that half, subject to the no other lien, and you'll do a quick partition action, and then you're golden. They start foreclosing, and they give notice to the holder of the mortgage that they are doing so, and that they intend to assert full priority over Kevin's half interest. Well, does anyone want to take a guess here what happened next? If you're sitting and saying to yourself that First American, through another agent, also insured the $340,000 mortgage, which only encumbered Carrie's half interest in the property, and no exception was taken for the fact that Kevin did not grant the mortgage in the granting section of the document, then you'd be right. His signature alone on the signature page was determined not enough to carry the day. So here, First American had a $340,000 mortgage on a property only worth about $340,000. But the mortgage is defective and it only encumbers half interest. And to conduct a reformation of that mortgage to assert that Kevin actually intended to encumber interest, we needed to deal with the other interest insured first, who had priority over Kevin's half interest. So to make a long story longer, First American paid the full $105,000 to satisfy the holder of the small mortgage, and then began the reformation proceedings against Kevin, which he fought, but then later caved. And Kevin and Carrie were no longer in a relationship together, of course, and he became willing to allow his property they'd gotten from his relationships to go into foreclosure. Suffice it to say, after paying a lot of legal fees and satisfying the $105,000 mortgage, First American was out of a lot of money for a couple seemingly small mistakes. Okay, so this one is called Factory Seconds. Now, this is an older one. I like to bring it up just because of its message about just because someone is an owner doesn't mean that they might not have their own intentions that are devious. So we call this one Factory Seconds. Our agent here was asked to insure a second mortgage in the amount of $90,000 against this home in Center Reach, Long Island, New York. The closing was conducted by the lender of September 3. Again, dates are important here, so try and stay with me on it. So September 3, the closing was done. The original mortgage was forwarded to our agent, who received it September 15th. So we're at 12 days now. Again, this is where it comes into, it's an older one, so there's no email, fax, whatever the case may be. After checking the legal description for accuracy, the agent submitted the mortgage to the Suffolk County Recorder's Office on September 23rd. So we're 3 weeks out from closing at this point. But it was rejected and returned due to some ineligibility. The agent returned the mortgage to the lender's office in New Jersey for correction, who then in turn sent it to their National Processing Center in Sacramento, California. The mortgage was then returned back to the agent and finally recorded on November 6th, 2 months after closing. Well, during this period of delay, the borrower decided to give 9 more mortgages to different lenders. They were aware of what was going on and decided to take advantage of the situation, all of which were recorded before our insured mortgage. The total amount secured by intervening mortgages was more than $750,000. The property was only appraised to be about $135,000. The borrower was believed to have fled to Greece and has never been seen or caught since. First American paid its insured lender the full policy amount of $90,000. So morals here, remember your responsibilities of post-closing. Here, the owner, borrower was aware and exploited the situation. Carelessness in this case led to the situation, and it was taken advantage of. Strict reviewing of simple items could have prevented it. And it's also just here to indicate the importance of timely filing of documents, making sure documents get to the county clerk's office as quick as possible, and making sure that they really are the correct items that we're looking to get. So this one is called Defraudster. We have about 7 minutes left, so I want to try and get through the next 2 cases for everyone. So we have a Bronx commercial property, and there was a sale of that property for the amount of $6 million. Consideration was part in cash and the other part a note to the seller. The sellers, two LLC owners, one as to 75% and one as to 25%. At the closing, the following items were resolved and occurred. Two contracts of sale, one for each LLC, each signed by their alleged sole member. Deed from LLC A to LLC B and LLC B, followed by deeds from LLC B to the insured owner, Mark Smith, claimed to be the sole member of LLC B. Well, there was a termination of a tenancy in common agreement between the two LLC owners, with a stipulation canceling an LP for an action by one of the LLCs against the other to prevent and enforce the prohibition against selling the property without the consent of both owners. Well, post-closing, everything went wrong. Both LLC owners stated that they never consented to the sale, and the documents were frauds, including the deeds, the consents, and the cancellations. Mr. Smith was a previous member of one of the LLCs, but had sold his interest already. We lost this in court, and the court decided the proper steps were not taken to authenticate the file, aka we did not establish that the party had the proper authority to sell on behalf of the LLCs. So I like to, again, just highlight the morals of this story, what could have been done here, reviewing LLC documents, reviewing corp documents, making sure that they're still members of the LLC. If we've gotten them, sometimes we may ask for tax returns to show that they're still a member of the LLC. Double check all work, including contacting any person giving a consent, a deed, or other critical documents. And then again, verifying the authenticity of documents. When a sole person is claiming to have the authority to act on behalf of an LLC, we double, triple, and quadruple check that all times. Okay. Last one I think I'm going to be able to get through here is we like to call the nightmare at Bass Lake. And it's a claim about extreme steps taken by an estranged husband to keep his dream home out of any property distribution in a pending divorce action. And it's a very sad case. In August 2007, a lender was insured as the first lien holder on a luxury home in a resort area known as Bass Lake. The mortgage and note were only granted by the husband, but simultaneously with the closing, an interspousal deed was recorded. Okay, that should be an immediate red flag here. We've all seen this many times. And again, it happens when maybe one spouse has better credit or even for estate planning purposes, but it still should show a red flag. In this case, the couple was a retired couple and the owner they'd owned the home for 30 years and the husband was obtaining a loan in just his name. But let's go back to the beginning on this deal. The agent got the deal from the lender indicating that the husband was to be the sole borrower, and his subsequent title search correctly identified the ownership of the property as being in both the husband and the wife. Great. And there were no other liens. The agent then properly advised that the borrower that either the mortgage would need to be signed both him and his wife, or the wife would have to deed her interest to the property and the husband. Okay, following perfectly. All that makes sense at this point. The husband conveniently at this point explains that his wife was planning on deeding the property anyway to him in any event, and the agent prepared the interspousal deed for them to sign. The husband helpfully offered to arrange for his wife's signature on the deed pre-closing, but she didn't need to be bothered with attending the closing. What the agent didn't know was that several weeks earlier, the wife had already filed for divorce from her husband, the borrower, and obtained a restraining order against the husband both as to her physical person and as to the marital estates. It seems he had started acting a bit crazy during the context of the divorce, particularly about his Bass Lake home. So the husband comes to the closing with his signed deed, in quotation marks, and the closing occurs and the agent records the deed of the insured mortgage and a loan policy was issued to our insured. Well, the wife, of course, discovers that her estranged husband had forged her name on the deed and had encumbered the property with a deed of trust, when she ultimately sued the lender for, which the title company had to provide a defense. So in this claim, the fates of the dream home and the insured liens were moving down two tracks destined to intersect. So on behalf of the lender, the company asserted a myriad of defenses, including the obvious defense that the mortgage had to at least encumber half of the property, as one rightful title owner voluntarily granted it. The entire fraud, though, became a pivotal issue in the divorce proceedings as well, as the wife was seeking the home as part of her divorce settlement, free and clear of all liens, including our insured mortgage, as it had been prior to the insured transaction. In the course of the depositions taken during the litigation, it became clear that the husband was going to do anything to stop his wife from taking his dream home. Sadly, on the last day of the divorce trial during a lunch break, the husband, fearing that he was going to lose the home, tracked his wife down and the wife's divorce attorney to a local restaurant where they're meeting, eating lunch, and he killed first the attorney and then his estranged wife. He then retreated back to his dream home, and after a 10-hour standoff with SWAT, took his own life. It's a pretty, like I said, it's a pretty awful and sad story. So, what about the claim, though, on our side? The estate of the deceased spouse continued to vigorously challenge the mortgage, and notwithstanding the obvious truth of the arguments that the husband voluntarily granted his half interest in the property, the estate was ordered a judgment against the lender as stated above. Due to the strength of the appealable issues, the estate did negotiate a settlement post-judgment where, for a lump of hundreds of thousands of dollars and very significant legal expenses, the estate assented to the encumbrance of the property. The property was ultimately sold for less than what was owed, and no one walked away from this situation happy. So it's right on time. There is my timer. I just want to quickly get to the last slide here. How to respond to claims. Claims happen. Don't panic. Be cooperative. Contact us. We're going to provide any details that we may need, and contact any insurance carrier you may have just in case. Where to file claims. This is our email address, claims.nic@firstam.com. Again, I want to thank everyone for joining me today. I'm sorry we went a couple minutes over. I do see there are questions.
Yeah, there are just a few questions. 4 quick questions we'll get to, and then we should end just about on time. The first one is, do you have an opinion if positive pay is essentially a requirement we should have in place for escrow account checks?
I don't have an opinion on that. I think it really depends what works for you. I like to say the safer you are, the better. That's my opinion on it. But I don't have a specific opinion on positive pay now.
Does title insurance carry over if someone does a quitclaim deed to add another party?
It depends on the party. This is the least favorite answer people get from us. It depends. Most of the time, when you add a new party, no, they wouldn't. Title may not transfer. There might not be a continuation of coverage. But again, that is also a claims decision. I am not claims counsel. I am just an underwriting counsel. Claims counsel has their own rules they need to follow sometimes. And there are specifics in the rate manual as to when there is a continuation of coverage. And it depends on the situation and the parties being added.
You mentioned a simple Google search on Chuck. Do we have a duty to research more than just Googling?
Again, that's another, it depends. Listen, I want to say when you're dealing with large commercial transactions, or you're dealing with the bigger the deal, the more research you might want to do. I always start when I'm underwriting a file, I start with a simple Google search of the parties, the properties, just to see what pops up. Google has come a long way, right? Google, the top results are usually the best results when you're doing research. Now, does that mean you may not want to you may not want to go through Westlaw or LexisNexis for a more in-depth search? I think that may depend on what your initial Google search shows.
Right. And this one last question, I think it has to do with the out of possession issue. So instead of the long established policy of taking subject to variation between record lines and fences of 12 inches or less, are you implying that purchasers should not take subject to any variations at all?
No, I'm not implying that. I want to be clear that I put that slide in there more to show a lot of times we may, depending on what we see is there, we may ask for pictures if it's less than 12 inches or more than 12 inches. Because a lot of times we hear, well, it's less than 12 inches, so we didn't raise it. I'm not implying that that is not the standard, that is not the procedure that people will follow from now on. I am just implying that there are cases where we see people fight for less than those 12 inches. Because that is what that slide is there to show. Because you're right. A lot of people, it's the variations when it's less than 12 inches. That's what's raised. I don't want to speak to as whether that should be your policy going forward. Again, I think you have to take it on a case by case basis where the potential, which county you might be in. That's another key thing you should be remembering. The 5 boroughs, 6 inches might be more important than a property out in Westchester or Suffolk or Nassau or Rockland. So again, another case by case basis, but I am not saying that because if it's less than 12 inches, it should automatically again be adverse possession.
All right. I just want to thank everyone for coming. Thank you, Tony, for a great CLE. We really appreciate your time. It's always a pleasure to work with you. 2 quick things. I will resend everyone all the material shortly. And there was a lot of questions about the TOD that Richard spoke about earlier. As we get more information, we will send them. We're working with all the municipalities to find out what the requirements for transfer docs. You know, somebody had mentioned about the deed superseding the will. So as soon as we have all the information, we will definitely send out a notice. Thanks again, everyone, and have a great day. We'll see you again in July. Thank you.
Yeah, everyone.